Cheryl to start.
Oh, okay. Fantastic. Thank you, Basma and Cheryl. Yeah, so welcome everyone to session 3. So this is a great session, I think. Lessons from the pandemic and a look into the future of climate change, because it's really, we've got 3 excellent papers that are very, very different. So Anatomy of FinTech Lending in China during COVID-19 with Difang HUANG, Modern Pandemics, Recession and Recovery with John Rogers, and Rising Temperatures, Falling Ratings, Effect of Climate Change on Sovereign Creditworthiness. So we've got a half hour for each paper, 15 minutes for the presenter, 10 for the respondent, and then hopefully we'll have 5 minutes left to try and take any questions. So the first paper, Anatomy of FinTech Lending in China during COVID-19 by Zhenyang, I hope I have these names right, from Xiamen University, and Difang HUANG from Monash University. And Difang, if you're there and your audio is working and you're able to share your screen, we will let you take it away for 15 minutes, and I'll try to give you a 2-minute warning.
Christie, just trying. Can you hear me? Just
yes.
Checking.
Yes,
Thank you.
we can hear you.
I got it. Thank you.
Fantastic. Perfect. Wonderful. Okay, so let's see if we can, so we've got, that's a good start. Have we got Difang? Can we hear you?
Yes, can you hear me?
Fantastic. Perfect.
Okay, so let's begin. It's a little late in my time zone. I'm currently in Australia. And we changed a bit about our title. It's now called the Shared Banking in a Crisis, Evidence from FinTech during COVID-19. And following the advice from GFQA editors. And it's a joint work with my PhD colleague, Zhenyang. Now it's assistant professor at the Xiamen University. And let's begin our talk today. So we first briefly introduce our paper. And in this paper, we multi out with 3 research questions. The first one is that do FinTech lenders provide credit customers, especially the new borrowers and the borrowers with credit constraint, access to credit during the COVID-19 to smooth shocks? And second question is that how resilient are these loans to shocks? And what is the overall benefit and the cost of FinTech lending, especially during the hard time of COVID-19? And we summarize the result in this paper in this slide. So we use the pandemic as an exogenous shock to study the loan outcome of bank and FinTech companies. And we find that FinTech companies have a sharper increase in credit provision than bank after pandemic, while the loan delinquency rate increased for FinTech borrowers, but not for the bank borrowers after pandemic. And we find out borrowers are more likely to use a FinTech fund to consolidate their bank debt and also to smooth their consumption. And we secondly introduce our data used in this paper. We have 2 sets of data. The first data is from commercial bank. The bank we study is one of the leading commercial shareholding bank in China. And we obtained a representative sample containing all credit card borrowing records during the July 2019 and June 2020. We choose this sample period because this is the perfect time before the COVID-19 and also after COVID-19. And we stopped the sample period in June, and there's some regulation change that take place after the July of 2020, especially the regulation on the FinTech lending on the specific customers' geographical location constraint, and so on and so forth. You can also find the detailed dynamics of FinTech lending regulation in our paper and appendix. And we also use the credit card borrowing as the most comparable form with the FinTech loans in terms of the loan characteristic and the borrower's characteristics. And our second data sample is from 3 of the largest FinTech companies in China, which contain all customer accounts from 2019 and 2020. We focus on the cash loan and the consumption credit services. But to compare with the bank loans, we focus on credit loans with pre-specified maturity and also the monthly repayment schedules. So we merged both samples with borrowers' demographic information and the borrower's credit history and also their current loan information. In total, we find out 74,591 borrowers with bank loans and 98,127 borrowers with fintech loans. And by using the detailed information of national ID, we find out 627 borrowers with both bank loans and fintech loans. And we introduced the third part is our consumer lending market. We first show the geographical residential distribution of fintech borrowers in China that covers the majority of many cities, especially in the eastern city and city overseas. And also the bank borrowers' residential address. And we find that they share quite similarity in both the geographic distribution and also the density. And also we show the distribution of both the fintech and the bank borrowers. And we next compare with the demographic variable, including the age, employment, income, education, gender, and marriage. We find out the fintech borrower tend to be younger and less likely have employed and less likely have high income and higher education, whereas they're more likely to be male and less likely to be married. And the second set of variable is about the credit history for the fintech and bank borrowers. We find out the fintech borrowers tend to have less asset, including the car and house, but while they have more liability, including the car loan and mortgage. They also suffer from more delinquency in the past, and also have higher historical balance, where they have also tend to have more number of loan and number of delinquency. And next, we analyze the third set of the variable, including the loan information. And we find out fintech borrowers tend to borrow more, as the mean loan amount is much larger than the bank sample, and they suffer from higher interest rate and relative shorter loan terms. And we introduce our empirical methodology. We use the definitive specification, while the left-hand side is the loan outcome for a borrower living in the city C at the month T. And on the right-hand side, we control for the fintech indicator that equals to 1 if a borrower has a fintech loan, and after indicator that equals to 1 if the time is after January 2020. And we also control for the observed characteristic, including demographic covariance, credit history, and loan characteristic. We also control for the city fixed effect and the city by time fixed effect, and also the borrower's fixed effect to control for the potential time varying heterogeneity and the special government subsidy targeted at a certain time of the certain period. And also we show the improved results as two set of group of results. The first group is loan quantity. And in this simple graph, we show the unconditional loan quantity for the bank and fintech borrowers before and after the pandemic. We find out there exists some difference between the fintech borrowers and bank borrowers before pandemic, while after pandemic, the demand for credit increased dramatically for fintech borrowers, while the increase is less dramatic for the bank borrowers. And we do more regression analysis using the different specification. On the first and second column, our dependent variable is essential margin, which is dummy equals to 1 if the credit is positive. And in the fifth and seventh column is the intensive margin, where we consider as log 1 plus credit. In both specification, we find out that fintech times after is significant and statistically significant and economically meaningful. And we further explain whether the severity pandemic partially can explain the increase for the loan quantity of the fintech and the bank loan. And we find out using the dummy for Wuhan city, Hubei province, and the top 10 Wuhan inflowed cities and top 10 COVID infected cities as the severity pandemic measure. We find out that even though the severity explains part of the loan quantity increase, it cannot influence the main result for the long quantity increase after the pandemic for fintech firms. And this is true when we consider the intense margin of the total quantity of credit for those companies. And the third result is related to the credit access to the credit constrained borrowers. As there is no evidence on the benefit of fintech lending to be documented in China, we consider two indicators for the credit constrained borrowers. The first one is a high and low income indicator, and the second one is the employment indicator. And we find out after the pandemic, the fintech companies still provide credit access to both high-income lenders and low-income borrowers, while the bank do not provide credit access to the low-income borrowers. This is also true if we consider employment indicator as the measure of credit-constrained borrowers. And it's also robust when we use in the intensive margin of credit access. And later we consider the explanation if the credit access to the new borrowers, especially during the pandemic, is an advantage for fintech companies. As we all know, fintech companies operate completely online, and during the lockdown and social distancing, it is one of the advantages to provide credit access. And in this simple graph, we show that the ratio of new borrowers for fintech companies is stable and even increasing, while the ratio for the bank borrowers is decreasing after the pandemic. And this result is robust, even if we divide the borrowers by their income level. And we move to the next set of results, which is the loan quality. We use the loan delinquency rate indicator, which equals to 1 if the loan is not is overdue before the deadline of 1 month. And we find out that the delinquency rate for fintech and the bank are quite close before the pandemic, and is less than 5%, while after the pandemic, the delinquency rate for bank is about the same, while the delinquency rate for fintech companies increased dramatically and do not go away when the COVID-19 is less severe in China. And we tested our result using the deep regression, and we find out for the outcome is the loan delinquency rate, even we include the demographic controls and include the city fixed effect and city by time fixed controls, and also we control for the potential non-linear fixed effect for the loan amount and non-maturity. We still have robust and economic meaningful results. And two potential concerns with our previous definitive results. The first one is that there exists ex-ante difference in borrowers' characteristics and also the credit attributes for the fintech companies. We address this concern using both the propensity score matching and the entropy balancing matching method. We show the results in this table, and we find out even if we consider a different sample with a very close characteristic between the fintech borrowers and bank borrowers, the delinquency rate difference still exists, and the result is robust when we also consider the entropy balanced, entropy matched sample, as there are much discussion in the shortcoming of propensity score matching. And the second concern, as we do not observe all fintech and bank account for each borrower in our sample. So, for example, for one borrower, he or she could have several bank accounts and a fintech account. So our observation may lack the sufficient observation for the outcome. So some our observed time may drive our results. And we address this issue using the seemingly unrelated regression results that control for the potential unobserved but correlated shocks. And in this specification, we find out that our results are robust and the economic magnitude are similar.
Difang, it would be ideal if you would be able to wrap up in a minute or two.
Okay, well, I'm just going to finish. No worry about.
Fantastic.
Thank you. So the long quantity result is not fully explained by the severity of pandemic, and is not fully explained by the pre-existing and the first-time user borrowers difference. And the one more potential explanation for the difference in loan performance is that FinTech borrowers may consolidate the debt using the FinTech loans. And in this graph, we consider 627 borrowers with both FinTech and the bank loans. And in this regression, we control for the borrower-specific that to alleviate the concern, some of unobserved about the borrower's characteristic may drive our results. In this regression, we still find economic significant results for the FinTech and the bank delinquency difference. And we may shortly discuss the implication for the pricing in the FinTech loans. Following the Zhenyang's paper, we find out the interest rate is a good predictor for FinTech loans before the pandemic, while it's not after the pandemic, while the result is robust for the bank loans. And we may shortly conclude our paper. So FinTech borrowers have higher credit access than bank borrowers after the pandemic, while the loan performance deteriorates while the bank loans are unaffected after the pandemic. And we also explore the potential channels that may explain the differentials and discuss the overall benefit and cost of FinTech lending. And thank you very much for your listening.
Thank you so much. All right, so we've got perhaps 10 minutes or maybe a bit less for Michael King from the University of Victoria, our discussant. And Michael, do you have any slides? Oh, fantastic. Take it away when you're ready.
Yeah, thank you, Christie, and thank you, Difang, for getting up in the middle of the night to share that presentation with us. And congratulations to you and your co-author on it now being forthcoming with JFQA. The version that I saw was not, so I can see some improvements. What I'm going to do then is therefore suggest ideas for how you can use the same data set and get a second publication, Difang, by looking at it slightly differently. And I think we all know what's going on here. FinTech platforms are providing credit to financially constrained borrowers who have worse characteristics, who then selectively default on their FinTech platforms, not surprisingly, if they have loans from both a bank and a FinTech platform. And what I think is missing from your whole story, Difang, is the FinTech platform itself, what kind of platform it is, who actually bears the losses, where the monitoring is. And what I'm going to suggest is that there's also a very important story here from traditional banking about the difference between relationship borrowers or relationship lenders and transactional lenders, which is another direction that you could have taken the paper. Okay, so I do think the paper is very well written, and I really enjoyed the empirical methodology. I thought that was very convincing, and the setting. But I think that it could be linked more closely into the banking literature for another hit. Okay, so the problem is that you've used the word FinTech lending and you've not said what kind of lender it is. And I've been studying research since 2016. There are actually many, many categories of FinTech lenders. The ones that involve individuals lending to other individuals are known as peer-to-peer or marketplace. There is another category where actually the loan is held by the lender, on their balance sheet. That's known as balance sheet lending. And these two will have very different incentives because of skin in the game. Okay, so another big thing that's in the background of your paper is that Chinese FinTech has gone through an explosion and a huge collapse over this period, but 86% of all lending by FinTechs in China is this peer-to-peer, meaning that a marketplace is just acting as a financial intermediary. You could see it as an originate to distribute model, where they have an incentive to give out as many loans as they can because they get fees for servicing and fees for origination. And then all the losses go to those poor retail investors. And this is why we see such a large run up in the number of platforms and then a collapse, because they had huge scandals in China about this, because there were so many that were effectively Ponzi schemes. Now, I'm going to go ahead and assume that because 86% of all loans are P2P marketplace, that is where your three platforms are represented. This chart from the BIS, just on the left, shows the rise of platforms, fintech platforms in China in red, and then the blue, the closure or the collapse, with black being the total number. And on the right, it shows the amount of volumes that have gone through and the stock. And as you can see, there's been a huge number of delinquencies over this period that you studied, which is very important context that is, it's touched on in your paper, but not really discussed, okay? So if you're interested, anyone who's interested in this data, there's two main data sources. One, the Cambridge Center for Alternative Finance, another, the BIS. They've actually published data on this, not only in China, but globally. And what we see is that peer-to-peer lenders have no skin in the game. They use algorithms to provide loans to individuals, and the money is coming from retail and going to retail, okay? So these are transaction lenders. They simply, this is what Lending Club does, this is what Prosper in the United States does. They do not have an incentive to monitor as strongly as, say, a balance sheet lender when a bank, for example, is lending its own capital, its own capital to borrowers through a digital platform. The other thing is, in China, there are no credit scores and no sharing of data between these platforms. So very hard for a fintech lender to know whether the borrower is good or bad based on their other loans or their past history, okay? Now, keep in mind that the data that Difang is comparing is he's comparing loans against credit cards. And credit cards are being offered by commercial banks to retail customers. So there are a very select type of retail customer that's getting this, okay? These are customers that have a relationship with the bank, probably have a corporate credit card, probably have a mortgage, probably their corporation has a loan. So the bank knows them very well, okay? And there's probably cross-default provisions on the loans with the bank. So if you have to default, who are you going to default with? You're clearly going to default with the fintech platform, because it will not have the same repercussions on you individually as if you were to default on a bank, okay? What are we talking about here? We're talking about this RFS paper, relationship lenders. We know that they charge more pre-crisis, but they continue to lend during the crisis. And that seems to be what's going on, that there is a distinction here between both banks and fintech lenders increased lending in post-pandemic, but the delinquencies all happen on the fintech side, okay, which is what we would expect if you're borrowing from a transaction borrower, not a relationship borrower. Now, that's not to say that these fintech platforms are not good, because actually this paper, also from the BIS, says that using these algorithms, they can do a very good job of predicting default. So the problem is not the platform itself and the algorithm. The problem is a self-selection one. Here's some papers that you don't cite, which you may want to look into. The problem is this self-selection one of who is borrowing. Well, the borrowers are, as you point out, financially constrained, single males, 30 years younger, taking out bigger loans, less employed, less income, less educated, more debts, shorter maturity, higher interest rates. It totally makes sense. If you look at who's borrowing from the banks, we see that it's more married females, older, more income, more educated, and of course, they are existing borrowers from the bank. So it makes sense. You borrow from both platforms, and that's a subset of about 600 of the observations. You have a choice, your cash is constrained, you default on the fintech platform where there's very low cost. You maintain and service your bank platform because you know that that's your relationship, that's where your credit score is, that's where your future lending is going to be. It totally makes sense. So I think there's a totally other story you can talk about here. And I think you started, you in the rewrite of your paper, you mentioned it. This is really about financial inclusiveness. This is about access to capital. These platforms are providing a valuable service because they are providing loans to people who would not otherwise get credit in a system where credit is hard to come by. So I think what you could do is you could provide more institutional detail on what type of fintech lender you're talking about, who is actually providing the money, who is suffering the losses, provide details about the other loans that the bank borrowers have, because even though you don't have all the fintech loans with other marketplaces, I believe you said that you have all the loans with the bank. Find out if there's cross defaults. And even though you do focus on the pandemic, which is the topic of this conference and is also useful, it would be good to see what happens in good times and in bad times, because these fintech platforms have been shown to be very helpful in good times to provide credit and to ease credit rationing in the economy. Okay, that's it for me. Thanks.
Fantastic. So we've got 4 minutes left for this paper. So Difang, I would suggest that you go ahead and take the time to respond. I don't see any questions in the chat, and I prefer not to go over time just so we don't squeeze out the third paper. So do you want to spend a couple minutes responding to some of what Michael said?
Thank you so much, Michael. This very detailed comments, and many of the questions that I think is really enlightening. So the most important question is where the money from the fintech, and it seems a little positive because the fintech is keep losing money, but they are keep borrowing to lending to the financial constrained borrowers and new borrowers. So the reason is that we consider fintech companies is not to peer-to-peer platforms because that is suffer from some regulation challenge. So they basically shut down during the COVID-19 time. The fintech companies we are considering is more likely to the other financial group. So they have very different capital structure. So they only have like 1% to 2% equity in the firm. And most of the fund they come from is from the second tier and the third tier commercial banks. So the commercial banks have a lot of money, but they don't know who to lend. And the Ant Financial Group is a good source for this money to lend. And they construct a very complex IBS option derivative product to make this fund invest in the relative high risk lending for the new and financial constrained borrowers. Is quite similar to the subprime mortgage crisis happening in the United States. So this is why the regulators are very worried about the increase in the fintech lending default rate, and they have the completely new regulation on the capital structure of fintech lenders, and also restrict the geographic area for the fintech companies can operate. Just the concern for the use of the money. So there may be a quite strong, large systematic risk if there is nothing to do. So this basically answers your first question on the more detailed on the fintech companies. And in the final revision, we actually made such additional comments on this one because it's really important. And second, I thank you very much for the advice for future research. I think they are very good and worth rating ideas. So I'm currently working on. So thank you very much. It's very, very helpful. Thank you very much.
Fantastic. So I don't actually see any questions in the chat, and we're 1 minute ahead of time. So you guys are really good. So unless someone has something they absolutely frantically want to put their hand up right away, then I think we're actually going to move on to the next paper. So we've got Modern Pandemics, Recession and Recovery from Chang at Fudan University, John Rogers from the Federal Reserve Board, and I'm going to probably say this wrong, ZHOU from Fudan University, Discussant Merwan Engineer from the University of Victoria. And if you're ready to go, John, we'll let John Rogers take it away.
Okay, great. Thanks very much. Everything okay on the hearing and seeing? Okay, fabulous. So thanks for inviting us. My co-authors were not as tough as the previous presenter. They are fast asleep in Shanghai, not waking up in the middle of the night. And thanks for the invitation. It brings back good memories. I think the very first professional conference I ever went to, I was on the faculty at Penn State, which was actually University of Victoria. I think the Canadian meetings were there. And although that was probably 30 years ago, you never quite forget, I certainly have never forgotten, the beautiful view taking the ferry over from Port Townsend, maybe it was, and approaching Victoria. So it brings me back to that. So I co-authored with Chang and Sili, and we examined 6 post-war pandemics, pandemics, basically to kind of get a little bit of a calibration on COVID, right? How big an economic shock has COVID been compared to past pandemics? So we sort of rip through a lot of data, mostly macro. We do a little bit of firm level stuff too, and estimate the effects of an identified pandemic shock on GDP, unemployment, and trade, basically. Find that impact effects are large from these past 6 pandemics. The bounce back effect and growth is rapid, but the levels effects are very persistent. So this bounce back and growth in the first year after the pandemic strikes is not sufficient to restore the level of GDP to pre-pandemic trends. And then we look at transmission channels from a little growth accounting exercise. In addition, bullet point 2 here, we find distributional effects are significant. I'll describe what those are. And international trade networks are important, and that fiscal policy aids recovery. So let me talk a little bit about the data and the econometric setup, and then just rip through a bunch of pictures and hopefully not take up more than my allotted time. So we all know, this heat map was drawn back in November. It's now 4 times as intense. We are ultimately want to compare these historical pandemics, again, in terms of the economic hit to COVID. So we look at the 1968 flu originating in Hong Kong, SARS, H1N1, one of the biggest in our historical episodes, MERS, Ebola, and Zika. We use a bunch of data sources that, the crises are identified in this really nice World Bank volume, in terms of the timing. Data on deaths and infections. We use both number of cases and number of deaths to sort of calibrate some of our panel regressions. Comes from the usual suspects, the World Health Organization, CDC, European CDC. Macro data comes from the World Bank and Penn World Tables data. Again, mostly GDP, unemployment. We do some of the components of GDP, consumption, investment, mostly going to talk about trade. All our country level controls come from that same data source. So what are we talking about here? About 200 countries are sampled that begins in 1960. So we have 313 country year health crisis observations. So it's 6 crises. It's about on average 50 countries were affected by each one of these previous health crises, again, on average. We also use some consensus forecast data. I'm not going to have any time to talk about that. And the bilateral trade data also comes from the World Bank. You can kind of see just from looking at just a raw, distributional graphs of the GDP growth data that basically what happens, focus on the left-hand column first, is that affected countries kind of have their GDP growth distribution skewed to the left. And that in the recovery year, they kind of bounce back pretty quickly to look like unaffected countries. So how do we get these estimates of the pandemic shocks? We're going to take 3 approaches, primarily, and certainly what I'll show you today, local projections, impulse response functions, a la Yorda. We do a bunch of panel OLS regressions as well. Just won't have time to show them, and who wants to look at tables with small fonted numbers during a conference anyway. But a bunch of panel OLS regressions allow us to back out a lot of our numbers that we calibrate. Then of course, endogeneity is all over the place. Here, potential endogeneity here. We devote considerable attention to that in kind of 3 different ways. We incorporate these consensus forecast regressions that severely limits the sample size because consensus forecasts are not available for 200 countries worldwide. We do some seemingly unrelated regressions. And then frankly, in what was a semi-heroic data construction exercise, we look at 18,000 firm observations and look at the firm level. Okay, how much were firms affected by these past crises? Okay, dependent variable. What am I going to rip through and show you these impulse responses okay, GDP growth and unemployment. Primarily, that's what I'm going to show you. GDP growth, unemployment, a little bit on trade towards the end. In the baseline, the shock is just a dummy for countries, 0-1 dummy for countries affected by the pandemic in that year. Again, it's pretty raw, and we do a lot to be more subtle than that, but that's the baseline. That's what I'm going to show you. 0-1. What was the country affected or not? Therefore, the local projections impulse response functions that I'm going to show you are giving you the effect of, on GDP growth from the pandemic on affected countries relative to unaffected countries. That's the key. What was the marginal effect of the pandemic hitting your country on GDP growth compared to countries that were unaffected? Okay, bunch of controls, usual suspects, trade to GDP, domestic credit, population, GDP growth per capita, the US recession dummy, country fixed effects, decade dummy, etc. I'm racing fast because there's a lot to this paper. Okay, here's the first result. GDP growth on the left, unemployment on the right. You can see a statistically significant and economically fairly large, about 2.3 percentage points off of the GDP growth in affected countries relative to unaffected countries in the crisis onset year. So this would be the equivalent of 2020. COVID is not in this data sample. Okay, but the bounce back is pretty strong, statistically significant, almost a full percentage point. It's 0.7. Okay, bounce back to GDP growth of affected countries relative to unaffected countries in that year. But the bounce back in growth, as I said before, is not sufficient to restore the level of GDP to pre-pandemic trends. And the unemployment rate also a fairly significant rise in unemployment and greater persistence of unemployment compared to GDP growth. Okay, so firms might be responding with, faster with production and sales are picking up, but unemployment lags behind that. Okay, let's break this down by education. So we're getting into some of the distributional effects here. Basic education, yep, gets hit pretty hard. Intermediate level education, yep, unemployment gets pretty hard. Scales are the same across these three panels. But with an advanced education, right, just kind of what we would expect. The less educated get hit worse. By gender, male unemployment, significant, female unemployment, significant and more persistence. And the hardest hit category would be females with a basic education, a larger impact effect and more persistence. How about by sector? Industrial sector, service sector, both get hit significantly. Again, this is unemployment. Agricultural sector, not so much. How about the channels? Well, we need a second data set, the Penn World Tables data set, to go through this growth accounting exercise. The first two plots here show you that the effect on GDP growth from either the baseline data set, World Development Indicators, or Penn World Tables is showing you the same thing. So don't worry about switching the data set for this purpose. And then we just look, we break it down. Is it the labor input, capital input, human capital input, or TFP that is accounting in a very, accounting sense for this drop in GDP growth. And we find that, kind of every category except human capital is doing some of that accounting. So I won't show you any panel regression tables and make you squint your eyes for the standard errors and whatnot, but let me just run through what those panel regressions tell us. GDP growth, so even if we're controlling for a whole bunch of more things we can control for in the panel regressions, also about a 3 percentage point off the GDP growth rate for affected countries relative to unaffected countries. Statistical significantly robust to excluding H1n1, but surprise, surprise, the effects are much smaller when we exclude H1n1. Why do we want to exclude H1n1? Well, the elephant in the room is that pandemic hit in 2009, the onset of the global financial crisis. So we take some steps, right? We know it. We recognize that coincidence, and we do what we can with it. Again, including just dropping H1N1 for the sample, from the sample. Control for consensus forecast of GDP growth. Again, it cuts the sample size way, way down and allows us only to start in 1990. Separate out all individual past episodes, which were big, which weren't. Some of them are statistically insignificant, but even some of the smaller ones had statistically significant effects on the growth rate. Instead of this rather crude 0-1 dummy for whether the country was affected or not, we estimate using severity proxies, either cases or deaths. And the effect on GDP growth is larger in the severe cases. If we restrict ourselves to the severe cases categories, approximately 3.5 percentage points off the GDP growth in the onset year. We estimate a system of seemingly unrelated regressions that allows for feedback between the probability of a health crisis, GDP growth, and government spending, okay, which you would naturally think is there in the real world, that feedback. Results are again showing about a 3 percentage point hit on the GDP growth rate for affected countries in the onset year. Firm level regressions, lots of firms, several thousand, a couple dozen thousand, I believe it is, firm observations. Sales growth shows a very large decline. I want to say 13%, I'm trying to remember now, in the impact year, a pretty big effect on sales growth. Investment declines, employment, profitability also decline, leverage ratios rise, and the effects on firms are more persistent. Let me get to this comparison with COVID. I know I'm running out of time, but I got like 1 minute left. So how could we compare? What's the size of the COVID shock? Well, we have a lot of information on 2020 now. It's basically data. The forecast from the IMF, in the paper we show forecasts from World Bank, IMF, and Consensus. The forecast as of January 2020, right before COVID was going to hit, is that world GDP growth for 2020 would be positive 3.3%. The latest IMF WEO is showing that GDP growth worldwide in 2020 was negative 3.2%, implying a COVID shock to 2020 world GDP growth of 6.5 percentage points. If we back out from our panel regressions, kind of the impact effect on world GDP growth, we get a range of around 2.6% to 3.5%, implying that the COVID shock is about 3 to 4 standard deviations worse than the typical past pandemic. And that furthermore, if you look at the very bottom row of that table, you can see that the markup, there's kind of a positive bounce back effect. This IMF markup of the outlook for 2021 is consistent with the bounce back that we observe in past episodes. The very last things we do in the paper, and again, I'll try to stick with time here, is to look at trade network effects. The idea here is that even if you don't get sick, your country is unaffected by the crisis, which again, everybody in COVID was affected, but your GDP will get hurt if your trading partners are affected by the health crisis. So we try to back out how much those trade network effects are in the data. Left-hand side panel is just the impulse response functions, the Jordan local projections for trade growth itself. You can see the hit to trade growth was huge, basically negative 20% off the growth rate of trade, about the amount that trade fell during the global financial crisis. The right-hand side panel is this decomposition where the red line is the indirect effect from your trading partners getting affected, holding constant the direct effect in ways, we do this in a way I don't have time to suggest. Final result, and then I'll wrap up here. We show that fiscal policy makes a difference in recoveries. On the left-hand side, high health expenditure response countries bounce back much more quickly than low healthcare expenditure response countries, even though the impact effect on both countries is about the same. Okay, so just to wrap up, kind of showed everything I showed here. One worry is that with COVID, open trade linkages, we show they benefit the macro economy, but one worries whether, is globalization dead? Are countries wary to be so reliant on imports, i.e. China, for high priority goods like medical goods? And we've just observed, of course, as we know, a resumption of pervasive China bashing in the West, and that's a subject that, along with my co-authors Xun and Chris Webster, we've been looking at that, the effects of hostility between these two countries. Okay, I'll wrap it up there. Thanks very much.
Fantastic, thank you, John. If you're there, Merwan, engineer from the University of Victoria, do you have slides to share with us?
Yes, I do. I'll try to share them. Are you seeing them?
Yes. Well, I should say we see, no, sorry, I spoke too fast. I don't see them now.
You don't see them. Okay, let me just try again.
Okay.
Here we go. How's that?
Yes, perfect.
Okay. Well, first of all, welcome, Roger, back to you, Vic, if only virtually. I enjoyed reading your paper. I learned a lot. I was under the impression that these previous episodes prior to COVID-19 were inconsequential for macroeconomics, and your paper has completely changed my mind on that. And also, it truly is a heroic data set of exercises on many dimensions, and also I would say on the statistical dimensions. You've taken the banking crisis literature, and that is very sophisticated, and you've done pretty well, it seems to me, most of the serious testing that literature has demanded. So I'll just do a quick review. The research question, as I see it, is how does the relative macroeconomic performance of affected countries, and here by affected we mean both pandemic and epidemic, compared to the unaffected countries? So that's the research question, rather than the absolute macroeconomic performance. And there's a reason not to address the macroeconomic performance, though that might be a more interesting question, is that it involves very complicated counterfactuals about the trend line. Whereas if you look at the relative performance, you can get the cross-section at a point in time, get good controls, and you have much more certainty about what's coming out of it. So I think it's a harder thing to do the absolute, and perhaps with almost impossible to get real confidence in your statistics. Whereas here we do get them. Why? Because, well, we have 200 countries over almost 60 years. So there's enough power in the statistics to really address this relative macroeconomic performance. Now, I see this paper as contributing very much to the business cycle literature, which has a long history of macroeconomics, almost from Keynes's time. Arthur Burns was trying to characterize what he termed the stylized facts of the business cycle. And what this paper provides is a set of stylized facts about relative performance with these shocks. And it's very thorough. It does it in these many different issues, GDP growth, unemployment, and others. And that's just, and really the stylized facts literally pop out of the figures. So here we go. We had this figure before. On the left is affected countries, and the red line is the bounce back. And you can see that from the blue to the red line, we've had a big bounce back for affected countries, much less so for unaffected countries. And so that gets to a key point, is that I was under some impression, I don't know why, that pandemics were almost all countries in the world. Well, that's just not the case of almost all, well, 5 of the 6 pandemics in this data set. They are regionally isolated, H1N1 being pretty well the exception, where it was pretty widespread across the world. So we have the takeaway: far greater recession and bounce back for affected countries. So that's one stylized fact, and we can go through them all. I'll do it. I think Roger covered it fairly carefully. Here's growth on the left-hand side, unemployment on the right-hand side. Again, same features. high impact effect of the recession, big bounce back, return to almost, but not quite the same level. Unemployment lags that pattern. Okay, so again, takeaway, bounce back, 5 years, some scarring because it doesn't quite get back to the level. Roger mentioned there's distributional consequences. Those females and less educated, well, the bounce back is, first of all, the impact is bigger, bounce back's big, but the recovery is much slower, and so scarring is bigger. I'll just quickly go there. I'd say these channels, I mean, maybe you have to cover every base, but this is totally what I would expect. So I didn't expect any change in human capital. These numbers are tiny because that's usually number of years of schooling, so on their way, it doesn't change. But the other things like labor inputs, the production, of course it would change. Investment goes down. And of course, our measure of our ignorance, TFP, well, that usually falls in most recessions, and there's a big mystery why. A lot of work goes into this analysis of trade, and it's important. And of course, we have contagion, not just of a virus, but of economic effects through trade, both directly and indirectly. And I won't go into it, but you know, there's a big impact effect, recovery of sorts, but not quite to the level. And so again, we get stylized things. Just a tiny question: what about trade restrictions? And you know, really, if it's Ebola, we don't want to have anything to do with that country. And even with COVID, there's, you know, there was, I think, sufficient restrictions in place that made it basically almost a quarantine of trade. So there might be other things out there for severe pandemics, which are literally direct. I love the policy here. You know, the takeaway is don't cut taxes, spend more, specifically spend more on health expenditures. And if you do so, here at the right panel, you get a big bounce back and a recovery, whereas low health expenditures, not really much, right? So, and worse for unemployment. Look, there's no recovery with low health expenditures. So that's serious. And it looks like most countries of the rich part of the world have actually responded appropriately, which is impressive. Okay, so what is my thing? These stylized facts, I think, are completely unsurprising and absolutely reassuring because they're intuitive. They're exactly similar to what you'd expect from an oil price shock or a financial crisis that's not permanent. And so that is, I think, very reassuring that they just nail that in many ways. What is surprising is quantitatively. They're surprisingly large. Okay, now I am going to put up a table. Oh my gosh, I don't know if you can see this. The shock here is minus 2.33%. Compare that to a banking crisis, minus 1.1. That's on the whole data set. Take out H1n1, which is the elephant in the room. It's still there. Banking crisis goes to 0. Well, that indicates that the real elephant for the banking crisis is, well, the Great Recession. Okay, they also do 1919, because that's where most of the pandemics are, except for the 1968 one. So pandemic shocks are on average more than twice as large as banking crises. And the question is why? And here's why I'm so surprised, and I learned about it. If so large, why has it been off the radar screen of most macroeconomists? I mean, if you ask most macroeconomists, they will not inconsequential. So that's hence the surprise of COVID. Well, I'm not going to fault their methodology. This paper goes through extreme lengths. So I'm sure referees have tortured you in doing every possible test. So I think you've done your best. But then, you know, really, are pandemics really exogenous? Are they short-run agri supply shocks? This WHO series comes from the, what is the dummy variable is a public health emergency. 313 countries, 1.5 shocks per country over 6 pandemics. That's almost, but almost 180 of them are from H1N1. And then they had to exclude many of the earlier ones. So it seems like it's almost 2/3 the data set. Now, H1N1 is the most widespread and the deadliest of these pandemics. How deadly is H1N1? Well, it's about as deadly as the annual flu. So in terms of deaths, it's not extraordinary at all. And yet it's driving the results. So that's my question. And I think you've partly answered it. Might H1N1 be statistically correlated with the great financial crisis? I mean, that's the elephant on the banking crisis side. H1N1 elephant on the pandemic side. You do take out H1N1, you do get results, but those are the remaining pandemics which were severe. And arguably H1N1, if you read about it, they just say it's the least severe of the so-called flu pandemics, the last 5 over the 140 years. So are pandemics really exogenous? Well, I'm going to give you a takeaway here. The WHO, I say they're exonerated. This paper has exonerated them. I'm just come out and say it, Roger, because if people are saying conspiracy theories against the WHO, you can say, I've done 3 sets of endogeneity tests, and they are not rigging their shocks for recessions. Okay,
Merwan,
so,
I want to make sure we have time for John to respond. So
okay.
I'm hoping you may be wrapping up. This is fantastic.
1 minute. Okay.
Okay.
So there is who's exonerated, who's guilty? Well, maybe it's Jameson et al. Why? Because they're associated with Lawrence Summers, who wrote the forward, World Bank, Gates. Oh my God, those are bad people, aren't they? And they identify 6 pandemics with the recession. Maybe they're picking the pandemics because of bad economics. I suggest take out the 6 pandemics as a test and put in all the shocks. Then you'd include the Russian flu, which has 700,000 deaths. You'd also include the Asian flu. Well, actually, extend the data set. You do that for the forecast anyways. And that has up to 5 million deaths with a smaller population. And that's more comparable to COVID. So that's a suggestion. Finally, a upshot. This is the November of 2019, March, and Canada's in red, and we fall off a cliff. America's in blue, they fall off a cliff, and OECD's in purple, even a bigger fall. But look at the bounce back. Wow. As of June of this year, we're almost back to where we are. Okay, we can't leave with too much good news because we have the D variant. So maybe there's another shock. Sorry for going over time.
Nope, that's fantastic. John, I hope you'll be able to respond in about 2 minutes.
Yeah, so I can take even less. Thank you very much, Merwan, for those comments. It's really quite nice. And please send me the slides so I'll remember about the Russian flu. Not to add that one. The other one is a bit earlier. We can't go back before 1960, but I was not aware of the Russian flu case. To incorporate some of your other remarks too, I think they were all really nice. The torturing was not, the paper actually got desk rejected by RE Stat, after all that work, desk rejected in whatever, 2 days or something like that. All the torturing was done by me on my poor co-authors who did actually did all the work. So with that caveat in mind, thanks again. Thanks for having us on the program. It's really great to present this stuff and get you thinking hard about what your research is trying to convince people of. So thanks again, Merwan, for the comments.
And John, there is a question in the chat, but I think we'll either hope that you might be able to address that if you do see that. Actually, 2 questions in a breakout or in a sort of a networking break at some point, if that's okay, because I think we will move on to the next paper if people are okay.
Sounds good. Thank you.
Okay, so fantastic, you guys. We're going to go to the third paper of this session. So rising temperatures, falling ratings, the effect of climate change on sovereign credit worthiness. And we've got Patty KLUSAK from University of East Anglia to present the paper on behalf of herself and her colleagues, researchers, Matthew Agarwala from University of Cambridge, Matt Burke from the University of East Anglia, Moritz KRAEMER from Goethe University in Frankfurt, and Kamiar MOHADDES from the University of Cambridge. And then we'll go to the discussant, Elham Tirhadman Zahad. After that, thanks. Take it away if you will, if you can upload or share screen.
Perfect. Let me just do this and share the from the beginning. And if you could tell me if it's working.
No.
Can you see?
No,
Not
I
yet?
don't see it. No. Not yet.
Let me see the second. I guess I have to pick the screen.
That works.
You're muted, Patty.
Yeah, we can see it now, but not hear you. We still don't hear you. Oh my gosh, I still don't hear you. And now, okay.
What I'm sharing, it's starting to mute me. Now you can hear me, I suppose, yeah?
Yes, we can hear you, but do you want to try screen sharing again?
Yes, let me do this one now. And now, can you hear me now?
Yeah, we can still hear you, but I don't see your screen. I don't see your screen.
Let's see. Now?
Yes. And do you want to put it in presentation view?
I will do.
Yeah.
If you can see me, whatever, if you can see me or not, but yeah, you can see
everything is working now. Take it away. All perfect.
It's a brand new laptop, so apologies. Everything needs to be set up. So thank you very much for basically introducing our team. We are a group of economists, environmental economists. We've got a person on board who has actually worked in the rating industry. Moritz KRAEMER has been with S&P for the past 20 years. So we are a nice bunch. And some questions that might relate to a climate aspect or science aspect, I will not be able to answer, but I will try my best to obviously give the flavor of the paper, which is basically a hybrid of different disciplines. So what I would like to do, just to fill you in a little bit, this is the only non-pandemic study in the session. However, it is quite, well, it actually does relate because as we know, climate is in fact recognized in loss of biodiversity and pandemics, which we see these days occurring as well. So it will be relevant to those who did stay. So if you think of the climate change, it is recognized one of the biggest market failures of recent years. And the Stern report in 2008 has actually outlined that certain inefficiencies and wide-ranging implications that climate has can affect not only environmental stability, but also economic, financial, political, and social. And beyond just the impacts that we see in terms of the environmental, social, and policy consequences of climate change and, let's say, global warming, is that it will also directly affect firms, investors, and regulators. And so there are possible channels through which we can see how climate change spreads. And we can see, for instance, the direct physical damages channels, which we observe by extreme weather conditions affecting us. Also consumer movements, when we see that there are riots and boycotts, protests by people, and that relates to reputational risk of companies that they need to consider. We've got transition risk that is relating to stranded assets or regulatory reforms. And finally, we've got the litigation channel, which is to do with the lawsuits that are being imposed on as a result of firms and entities as a result of the environmental damages that they want to sue for. So we know that there is a global basic pressure, and financial markets are feeling that the market participants and businesses should somehow control and should factor in their decision making the climate change. And we know that from regulatory standpoint and obviously from investors' point of view, the climate risk disclosures should be demonstrating that not only the business practices, business portfolios are actually in line with, let's say, Paris Agreement. So all of this is sounding quite good and optimistic. However, we feel a little bit, we feel it's a little bit of a greenwash. Together with our co-authors, we know, yes, it's good to talk about climate change being bad, but knowing this is the case is not good enough. And investors, regulators, and market participants need to know, and they need to have some underlying information on based on which, and obviously science-based information, based on which they can price the risks of climate change, and they can then try to avoid them and mitigate them. And so what we want to do, we want to merge the science that exists with the indicators that are something that investors are already familiar with, and they already know how to interpret them. So this is basically the aim of this paper, to gap these two fields. And as you will already see with all the sessions that we have on ESG, that's becoming a very big market on environmental, social, and government aspects. And there are a lot of business and enterprises basically enriching themselves. However, we are not as enthusiastic. First of all, there is no regulation really on these vehicles, and also there are some issues with actual underpinning assumptions and science, whether there is any science behind them. So what I'm going to do, I'm going to try to tell you the story. We are trying to adjust the existing indicator, which is sovereign rating, and we want to see whether that rating is going to change as a result of climate change. And we are going to perform simulations in the coming years over the century up to 2100 using 108 countries, and we are going to do the simulation using 3 various warming scenarios. So I'm going to take you on a little climate time travel, and I'm going to fast forward through time, and we are going to keep everything the same except these climate impacts on key macroeconomic indicators, and I'm going to mention what these are. And this time travel is going to allow me to see and maybe perhaps answer questions of whether our journey that began some time ago, where are we heading with this, and are we going to benefit if we stick to some of the agreements that have been already put in place, or do we need to try a little bit harder? Finally, I'm going to talk about something that most finance people will be interested in money value of these changes, and what will be the cost of servicing debt for sovereigns, for instance, as a result of changes to ratings and affected by climate. So how do we conceptualize this study? I'm just going to click all the arrows that there are. I'm not going to go in one by one. So I wanted to give you the overall picture. So the blue boxes on the very top are basically things that we are using, and this is not work from scratch. We are not reinventing the wheel. We are soft linking climate science and climate economy models. And what that means is that we are using model that can quantify the changes in precipitation and temperature into the actual GDP growth and GDP measures. And so that the blue is not our work. There are lots of different macroeconomy models that will do this for us. And some of them, let's say the Bill Nordhaus model has received a Nobel Prize for doing such quantifying measurement of climate science into the economic terms. But we are not using his model. We are using the model of Khan et al. 2019 actually it is. It's our co-author, and we are using this model, and there is a specific reason which I'm going to explain. And so on the right hand side, we've got sovereign rating box. That's exactly what we're relying on in terms of the indicator. We are again not doing anything new here. This is the S&P, the biggest rating agency model that we are using based on the transparency and the methodologies that are being released, and also having a person on board who actually served in these methodology teams for 20 years. We are able to hack the S&P credit rating. I am saying hacking because we don't really have the actual we don't have all the components of it, but we can see from the reports and from the methodologies what is being used. Now, the green boxes represent our addition to the literature and what we do in this study. So let me tell you, in order to actually explain, if we want to obtain a sovereign rating, there will be an aggregate of variables, which will include government performance variables, variables relating to the political risks, ability, willingness of the country to pay for the rating, and so on. And we will try to plug these, and we have a data set which we constructed for 108 nations that actually have a rating. And to hack the ratings, we are trying to use variables that not only would be used in the model, but the variables that for which we can also obtain adjusted values as a result of changes to temperature and precipitation. So in a way, from Khan et al., we obtained the two main variables which any sovereign model will use, which is namely GDP and GDP growth, but we also need more than that. And no clients, no science model on climate unfortunately can provide that. So we need to go out and we need to do a little bit of extrapolation. We are using Standard & Poor's results that they've done in the house as a result of extreme weather conditions in several nations over the years, and they give us some balance accounts, account balance performances, fiscal accounts, and these sort of variables, and we are able to extrapolate them. So we use those for our simulation. So we in fact have 6 variables. So we are parsimonious, but we can then do what is the main purpose on the paper. We can actually adjust the ratings which we hacked from the sort of baseline, and then we can adjust these variables which go into the model, and we can see what will happen in 2 scenarios, one with climate and one without the climate. And this is the first study that does it, and that actually looks into the future to simulate ratings. There's only one study that looks in the sort of backway looking from IMF, where they're looking the existing and past ratings to see where the climate was actually incorporated in them, and they don't find such evidence. So what we do at the end, to give a little bit of obviously a stronger message as well, because saying to governments and finance ministers, oh, it's gonna result in 2 notches or 3 notches, doesn't really mean anything. We quantified the results into adjusted cost of debt at the end of the study, and we use literature from top finance papers which have already established that for us. So the purple is our bit at the end, but we use some previous studies that help us calculate this. So without any further delay, this is our predictive capacity of the model just to hack the ratings as they are. We are not incorporating any changes in terms of the climate here, and we have the whole sample, and exact match is situation when we can tell that we actually are able to predict the rating of the country at a certain point of time. And 67.9 or nearly 68% of the cases, random forests, so our AI method allows us to do that with the existing sample. And then we also look what would be the sort of discrepancies from these exact matches, and we can see that within 99%, within 2 notches, we are able to predict the rating for those 108 nations for the sample period. And we also do out of sample splits, and we are able to, again, exact match approximately 32%. And obviously that number is lower now. And we also do some subsamples where we, let's say, take countries which would seem to be problematic in other studies, in other pieces of literature. They would find, okay, maybe they want to exclude Iraq or Ecuador or Argentina because of several downgrades that they faced, and that Black history might impair, you know, the model and its ability to predict ratings. So we do different subsamples as well to check that, and we decide that even taking investment grade out or taking the problematic countries out is not really benefiting us so much. So we decided for the comprehensive study like this, we prefer to keep all the countries in. So we're keeping all 108 countries in this. And just to represent this graphically, it's always easier to see. We have quite a good coverage between 0 to 2. It's the very dark green. These are within 2 notches. Let me just move this around. 0, the very dark one, is the precision of the model, and then you're going a little bit lower with your precision in terms of their predictive capacity. So now, if we go into the adjustment bit, because really this is where we are not hacking the ratings for nothing. We want to now implement these climate adjustments, and we want to see what will happen for these nations along the time from 10 years from now on, more specifically 2030, then 2050, and 2070, 2100. Finally, that's the final bit of the simulation. And we are looking.
Sorry to interrupt, but I just give you a time check that you have a few minutes left.
Yeah, that's fine. And so these are the results, just showing after that. So we will just, for those who don't know what RCP is, it stands for a Paris Agreement temperature approximating 2 degrees Celsius. If we carry on the track with our current and past 15 years of emissions, that's the RCP 8.5, which is 5 degrees Celsius warming scenario. And we finally do something which has been lately quite a big breakthrough in the climate literature, which is the variation in temperature, not just the trend of warming scenarios, but it's actually the variability in the temperatures, which we are going to check as well. So the prediction on the left-hand side in the 2.6 doesn't really look like there's much happening. Only a little bit difference of the fitted line from the solid line indicates the countries on the very top of the scale, which are the most credit worthy, will lose out. But if you think of the predicted ratings on the right hand side, for the 2030, we already see a drop there. And so the countries which are sort of at the top, the richest, they will actually see changes there. And if you zoom in for this 2030 scenario, which is actually quite soon, our lifetime, 63 sovereigns are found to have about, on average, 1 notch downgrade in the 9 years to come. If we think of 2100 under this scenario, which is the 5-degree warming, it's something much more severe, and quite worryingly, we have China with -8, so 8 notches downgrade. We've got Brazil between 2 and 3, and advanced economies with varying between 3 to 6 notches. So that is something quite spectacular. Now we take in the science, the Nature papers that have been published lately, and we add volatility. So the baseline is just the trend for the 20 up to 2100. Now we're adding on the right hand side this volatility that we've seen in the recent month. Texas, what happened? You have the drop in temperature and people actually are not able to heat their homes. There were some deaths as a result of that. That volatility I am talking about. So this is quite a significant drop. Presumptuously, you can see 2030 being quite a big drop, even in comparison to the previous one. And so the message we are trying to convey, these results are only physical risks, which we are basically not focusing, and we are underestimating the effects, because we are not talking about the transition risks, we are not talking about climate crisis. So when you have refugee crisis, where you have a social and political crisis, there are no indicators that we can plug in at this point to to materialize them in the model. But if we were to take these underestimations and calculate the actual additional cost of funding for sovereigns, we do that for corporates in the paper too, we would end up with lower and higher sort of band. And RCP 2.6 is Paris Agreement. It's not really much. It's 22 or 23 billion up to 34 billion in our sample of 108 nations. But if you're moving into the RCP 8.5 without variability, it's 136.8 of additional costs. We are just talking interests, okay? Up to 205 billion.
Sorry, Patty, but is it possible to wrap up in about 30 seconds to a minute?
I actually finished. So basically, it's the main results that we are going to say, if you are to borrow now, because it's going to just get more complicated. Decarbonization is going to get more expensive, and changing the infrastructure and energy systems is going to become more and more expensive as we go. So I guess this is what I wanted to say. Thank you.
Okay, fantastic. I just want to make sure that we've got time. Is Elham there and able to share the screen? Yes.
Hello. Yes,
Hello.
I'm sharing my screen.
Lovely.
We hear you, but I don't see your screen.
Okay, I don't share yet. Just give me one moment. So. Yes. You can see my screen now.
Fantastic. And if you just put it into the presentation.
For sure.
Perfect.
Okay.
Fantastic.
Great. So thank you so much. I'm delighted to be here to discuss the paper. And congratulations, Patty and your team. It's great work and research. I really enjoyed reading that, and also I learned a lot. I wanted to note that I am like a technical person. So my background is mathematics, and I'm using my expertise at the University of Montreal to do research and develop machine learning methodologies in sustainable finance, and especially for climate change risk. I hope that I give you some comments related to that. So just a summary of your work. That objective is the effect of climate change in the sovereign credit rating for 108 countries, and the contribution is the bridge the gap is between a climate science here and the real world financial indicator. And as you mentioned here, that first you have some to find that effect and the relationship. You talk about climate economic model, and then you inspired by the work of Khan, and you use two indicators from their work, climate adjusted GDP, and then climate adjusted growth, and also 4 indicators from S&P government performance variable, and then feed in your machine learning model to actually predict sovereign credit rating. So, and I guess because you use sovereign credit rating in your model, there should be maybe 1 hour here, because you use these data for your model to learn that what is, and to predict sovereign rating prediction. So, and then you fit in, you use this model, and then to have climate adjusted rating, and then at the end, as you showed, it's like they use that data for to talk about cost of debt. And this is like the whole picture of your work, that first you develop a random forest machine learning model to predict sovereign credit ratings. And then you train it on severity rating issued by S&P to maximize its predictive accuracy. So you combine climate economic models and S&P on natural disaster risk to develop a set of climate adjusted macroeconomic data to fit the rating prediction model created in the first step, and then feed your model with climate adjusted macroeconomic inputs under a range of policy and warming scenarios to simulate the effect of climate change and severity rating for future. And then at the end, use existing research on the effect of severity downgrades and yields. You calculate the additional cost of corporate and sovereign capital due to climate-induced severity downgrades. And as you know, though, like, because my expertise is more on machine learning, so I would like here to give you some comments related to your machine learning model, which is random forest. So the random forest that you created, you have like a big picture at the right side, and then you input the data. It's just 6 factors of 6 indicators that you use, and then you wanted to predict as a prediction the severity and creative rating. And you see here, like in random forest, we have some bunch of trees, and then you can choose like a number of trees, and then you predict in each tree, and then you average all prediction to have the final prediction in your random forest. Why random forest? This is something that I found like the reason that you provided, that why you use this methodology, not you use other methodologies in your work. And you said that is already applied in credit rating prediction. Most obvious modeling approach, you can handle nonlinearity because you discussed that, that there are some relationship between some indicators with the severity and credit rating, which is like a non-linear relationship. And then it just, you said that is be close to the actual practice of a severity and rating assessment. So I would like to start with my comment. And is a well-written paper, thank you so much. And then a really interesting topic, and the result is very valuable. And the reason that you describe in your paper are not strong. So usually we don't say like those things when we want to say that, okay, we chose this methodology to have to predict something. You don't show the distribution of labels. We don't know actually the data that you used the machine learning models, is imbalanced data or not, which is very important. That's for us to see. You don't show enough metrics for evaluation. You only showed accuracy. Accuracy is not reliable, especially when you have imbalanced data. So you cannot say, even if you say 99%, you have 99% accuracy when you have imbalanced data, it doesn't mean anything. You don't show like a parameters of your model, because in random forest, I will explain all of these in details in other slides. You didn't show that what is your parameters because you have some parameters in random forest, and if you change these parameters, you will have different results. And then something that is like a good to assign your paper, that you use a variable selection, which I appreciate that one. Choice of random forest algorithm. You said that is is something that is most obvious, but I found one article in literature that you also I found it like in your paper that you refer to that paper. It's just that they use something close to you, and then I found that you see here that they use super vector machine SPM, and then they found actually 50% accuracy, and even 5% accuracy when equal in notch is equal to 2. So
I'm just going to jump out a comment. We are coming to the close of the time, and I want to ensure that Patty has a opportunity to respond. So keep going, but we can try to wrap up.
Okay, for sure. I will be quick. So, and this is the distribution that I found in one of the literature that you also refer to. And you see here that they showed actually what is the data. You see, like you can see the distribution and what are the labels. And this is my suggestion that if you can put this distribution of your data, that would be very valuable for us to, like any person that read it, understand that, and then we can actually judge your model. And this is like tuning parameters. It just like there are different kind of parameters in random forest. I can give you these slides. So these are something that if you put this data, it just is for, and if you change something, and then if you have different accuracy or different evaluation metrics, it's good that you show these results. And then just a comment here that you show like a relationship between GDP growth and rating. And then your rating was a classification problem. So it just, as you saw here, you see here that you have classes, and then you change classes to numbers from 1 to 16. And then here you have your rating from 11.2, which is the float number, which is not actually, it's not 11, 12. You know, here you have 11.2 to 12 that I'm not sure like why you have that rating. And then like you only have the dependency over a small range of number. And then you use that. And then at the right side, you see here that you show that, okay, when we feed in more data, so it just extended the data from 2004 to 2020, your accuracy is lower. But it's good here that you showed you show like how the data is different. You know, if you show the distribution of data, then we can see that, okay, what's the reason that from 2015, like if when you extend the time, you have different results. And I think you miss some percent here because you have percent here, but you don't have percent sign. And I think, yeah, that's it from my side. Is that it's just most of these things are suggestions, and I hope that are useful.
So thank you so much. We are over time, but I'll give Patty an opportunity to respond and then turn it back over to Basma or whoever's wrapping things
Thank
up.
you very much. I'm unfortunately not the machine learning person in the team, but I would appreciate the slides, and maybe if I could email you and my guy can contact with regards to these, because they are good points. We have tailored the paper for the management journal, and it's the reason we don't have these figures and I guess the statistics that, you know, science journals would be looking, or mathematical journals would be looking for, but I guess we might have them somewhere. Thank you very much. The methodology is new, but it's only being applied in 2 or 3 studies that you actually kindly shown, and none of them forecast ratings into the future in terms of the climate. But the previous methodologies are linear, or even if they are discrete, they are not as good as actually handling the data constraints. So that's why we did it. But thank you very much for all the help and comments, and we'll be in touch. Thank you.
Yeah, thank you so much.
We do have a question from Michael. Do we have time, Basma, to answer it? Okay.
I already got an answer. Thank you.
Oh, fantastic. Fantastic.
Yes, thank you very much, Michael. Thank you.
Basma, are we turning it back over to you then?
No, you can wrap up. I guess our first day is done. So.
Okay. Well, fantastic, everyone. Thank you for some outstanding papers and a great keynote. And then we'll just see everyone back tomorrow. Is that right, Basma? There should be a separate, you should have it in your calendar in a separate day, but same link. Anything else I need to impart here? No. Okay. Thank you, everyone. And we'll see you hopefully all tomorrow for more fantastic work. Thank you.
Thank you very much.
Thanks, everyone. See you tomorrow.
Mm-hmm.
And if anyone wants to hang out for a few minutes, talk with other people around, feel free to.
Oops. Bye.
Merwan, I think you enjoyed reading the paper on the pandemics.
Thank you, Cheryl, for everything. Yeah.
I don't know who's showing up as me. That's not me, but also thanks for the sessions. Someone logged in using my name, which is really weird, but.
Oh, okay. And that's weird.
I know, I think maybe they were having trouble getting in. So maybe that's my only guess why someone would sign in as my name, but I saw someone come up. I'm like, okay, it's weird.
Oh, wow. And we admitted.
I did admit them. I figured.
I just assumed you were logged in twice because you were doing you were recording with one of them or something. Yeah.
Nope. Oh, I'll stop recording though. But.